an interview with Reuters, the CEO of Chase Bank, Jamie Dimon, has stated that the battle against inflation is not yet over. While there has been a recent decrease in inflation, Dimon warns that reaching the Federal Reserve's target of 2% will be more challenging than people anticipate and will require further efforts, including the potential for higher interest rates. He cautions against declaring victory too soon, stating that the decrease in inflation for just 1 month should not be taken as a sign that the economy is back on track. According to him, it will take more work to bring inflation all the way down to 2%, and this may require the Federal Reserve to raise interest rates higher than 5% and stay there for some time. Continuously raising interest rates could cause more damage to the economy and lead to more layoffs. But many people are not predicting this outcome, and some are even betting that the Federal Reserve Bank may start cutting interest rates to stimulate the economy, but this would likely cause an increase in inflation. Despite this, Jerome Powell has no plans to pivot or cut interest rates and wants to keep raising interest rates until inflation comes down. The Federal Reserve Bank considers two inflation numbers: the headline inflation number, or the CPI, and the core inflation number, with volatile numbers like energy and food taken out. Russia recently announced that they will reduce oil production, and it's expected to affect gas and oil prices. The extent of the impact on gas is uncertain, but there has been a general uptrend, which will increase inflation, as the increase in gas prices are factored into the production and transportation of goods. Another factor that could contribute to higher inflation is the unexpected upturn in the housing market due to the decline in mortgage rates in January and towards the end of December. Inflation data, like most data, is a lagging indicator, meaning that it is reported after the fact and decisions are made based on past data. It will be interesting to see the inflation numbers in February and March, as well as the job market, since a strong jobs number can also contribute to higher inflation, leading to higher interest rates. Despite a strong jobs number in January, the economy is still in a strange position, with rising inflation and uncertainty in the markets. When a strong jobs report is released, the stock market tends to drop because people fear it could lead to higher interest rates and economic pain. This is creating an unusual situation, especially since a strong jobs report would normally suggest a booming economy with rising stock market prices. However, some CEOs are predicting a recession while others claim there is no sign of an economic slowdown. The divergence in their opinions has been growing wider and wider. The struggling tech sector is one example of the economic slowdown, which has been partly caused by a decrease in advertising spending. Investors are also demanding higher returns due to the increased borrowing rates caused by higher interest rates. Some companies are reporting a slowdown in the economy, indicating a possible divergence that could get wider in the coming months. The economic outlook remains uncertain, with some CEOs predicting a recession while others see no sign of economic slowdown. The tech sector is particularly struggling, partly due to the economic slowdown and a drop in advertising revenues. Investors are demanding higher returns due to higher interest rates, making it harder for tech companies to raise money. Despite the uncertainty, it is important to prepare for the worst by having cash to protect against emergencies and to capitalize on investment opportunities. If asset prices go on sale, a passive investment strategy in the stock market is great. A strategy which involves investing regularly regardless of market conditions. Every week, an automatic withdrawal of money takes place and is deposited into your investment account, which will allow you to dollar cost average and invest safely, even in the worst market conditions. Be sure to subscribe, and thanks for watching.